On the Monday after the United States and Israel launched strikes against Iran in late February 2025, three companies saw immediate returns. Lockheed Martin stock jumped 3.4%. RTX, formerly Raytheon, rose 4.7%. Northrop Grumman posted a 6% increase. This happened while the broader market was down. The conflict that has claimed hundreds of lives, displaced thousands, and brought the Middle East to the brink of a wider regional war has been extraordinarily profitable for a very specific group of people. Not soldiers, not civilians, not even governments, defense contractors. Since the Israel-Iran conflict escalated in mid-2025, the iShares U.S. Aerospace and Defense ETF has gained 14%. Lockheed Martin and Northrop Grumman have seen substantial share price increases. RTX shares are trading with what analysts openly call a war premium, up approximately 10.4% in the month following the strikes. Global defense spending hit an all-time high of $2.7 trillion in 2024, up 9.4% year over year. The U.S. alone is spending nearly $1 trillion annually on defense, and the Trump administration is reportedly planning to push that to $1.5 trillion by 2027. This isn't just about weapons, it's about who gets rich when nations go to war. And the answer is always the same people. Let's start with the biggest player, Lockheed Martin. The world's largest defense contractor generated $68.4 billion in revenue in 2024. That's more than the annual budget of the entire U.S. State Department. The company manufactures the F-35 fighter jet, Israel's air superiority backbone, along with precision-guided munitions, missile systems, and space technology. When Israel launched Operation Rising Lion against Iran in June 2025, F-35s were the primary strike platform. Every mission flown, every missile fired, every part replaced generates revenue for Lockheed. And the company's order backlog? Tens of billions of dollars in Department of Defense contracts, many tied directly to Middle East operations. Then there's RTX, formed in 2020 through the merger of Raytheon and United Technologies. In 2024, $43.6 billion of the company's revenue came from defense. RTX manufactures the Patriot missile defense systems, the Tamir interceptors used in Israel's Iron Dome, and the bunker buster bombs repeatedly deployed in Gaza and Lebanon, weapons that are prohibited for use in areas with high civilian populations but have been used anyway, generating high civilian casualties and driving demand even higher. First quarter 2025 sales for RTX reached $20.3 billion, up 5% year over year. The order book swelled to a record $217 billion, $92 billion tied to defense alone. That's nearly 3 years of revenue visibility. And as one analyst put it bluntly, with Washington now openly on the trigger and Israel leaning on Raytheon technology for every incoming salvo, RTX shares are trading with a war premium. Northrop Grumman, the third giant, focuses on unmanned systems, radar technology, and long-range strike capabilities. The company has seen its stock surge 5 to 6% with every escalation in the conflict. L3Harris, GE Aerospace, Howmet Aerospace, all of them have posted similar gains. These aren't companies making money despite the war, they're making money because of it. Now let's talk about what this means in real money for investors. Raytheon's total return for investors over the past year is 82.69%, outperforming the S&P 500 by about 46%. That means a $10,000 investment in Raytheon before the October 7th, 2023 Hamas attacks would have produced an $8,269 total return. Not over a decade, in a year, while people were dying. Lockheed Martin has delivered similar gains. The stock was tepid in early 2024 to 2025 due to concerns about shifting defense priorities, but staged a strong rebound as the F-35 played a pivotal role in U.S.-Iran operations. Northrop Grumman, L3Harris, and others followed the same pattern. And this isn't speculative. This is documented, predictable, and openly discussed in financial markets. Defense stocks follow what analysts call a conflict escalation, stock price surge pattern. When tensions rise, stock prices rise. When strikes are launched, stock prices jump. When ceasefires are discussed, stock prices flatten or dip. The industry has also shifted its business model to resemble recurring revenue structures similar to enterprise software. Maintenance contracts, long-term service agreements, and lifecycle support now comprise a large portion of defense revenue. It's not just about selling a fighter jet, it's about servicing that jet for 30 years, replacing parts, upgrading systems, and training operators. The business model is designed to generate profit not just during wars, but for decades after. And critically, these companies don't just wait for conflicts to happen. They actively shape the conditions that make conflicts more likely. Here's where the story gets darker. Because defense contractors aren't passive suppliers waiting for government orders. They're actively lobbying Congress to increase defense budgets, approve weapons sales, and maintain conflicts that drive demand for their products. During the 2022 election cycle, Lockheed Martin contributed nearly $4 million to political candidates. RTX, Lockheed Martin, and General Dynamics were the top three companies lobbying the House's version of the annual defense policy bill. These aren't small investments. These are systematic efforts to shape policy in ways that benefit the defense industry. Aaron Acosta, program director at Investor Advocates for Social Justice, put it plainly, defense contractors are often the ones creating demand by lobbying the U.S. government and pushing for sales of these weapons. They're not just responding to market forces, they're manufacturing the market. And the conflicts of interest run deeper. Members of Congress, the people voting on defense budgets and military interventions, own stock in these same companies. Disclosures required under the Stock Act reveal dozens of buys and sells in aerospace and defense names throughout 2025, many of which delivered substantial gains as the war unfolded. One Congresswoman, Ashley Brooke Moody, stands out for the scale of her early bets on Howmet Aerospace Inc., a critical supplier of engine components and structural forgings used across military aircraft and missiles. She bought heavily before the conflict escalated. The stock surged, she profited, and she voted on defense bills that sent billions more to the very companies she was invested in. This isn't illegal under current rules, it's just grotesque. The people deciding whether to fund wars have direct financial interests in those wars continuing. As one analyst put it, where there's war, there's money to be made. And the people making it include the ones voting to start the war in the first place. The U.S.-Israel-Iran conflict isn't happening in isolation. It's accelerating a global arms race that's driving defense spending to levels not seen since the Cold War. Europe increased defense spending by 17% year over year in 2024. The Middle East lifted outlays 15% to an estimated $243 billion. NATO countries concerned about U.S. commitment to collective defense under the Trump administration have announced massive increases in their own military budgets. Poland, Germany, the UK, all ramping up procurement. And American defense contractors are the primary beneficiaries. European countries buy American jets, American missiles, American radar systems. The UK's BAE Systems, Italy's Leonardo, France's Thales, and Germany's Rheinmetall are all growing, but they occupy positions within the top 20 defense contractors globally. The Trump administration is planning to request an additional $500 billion in Pentagon funding over the next year, with an immediate $50 billion supplemental request reportedly coming as soon as this week. That money doesn't go to soldiers' salaries or veterans' benefits. It goes to procurement, to contracts, to the same companies whose stock prices jumped the day the strikes were announced. And the cycle is self-reinforcing. More defense spending means more contracts. More contracts mean higher stock prices. Higher stock prices mean more lobbying budgets. More lobbying means more defense spending. The industry has created a machine that feeds itself, and war is the fuel. It's not just American companies profiting. Israel has its own defense industry, and it's booming. Elbit Systems, Israel Aerospace Industries, and Rafael Advanced Defense Systems are all major players. Elbit manufactures drones, missile systems, and electronic warfare technology used extensively in Gaza, Lebanon, and now against Iran. Israel Aerospace Industries produces the Arrow missile defense system and various UAVs. Rafael developed the Iron Dome system in partnership with Raytheon. These companies have seen record orders as the conflict has escalated, and the relationship between Israeli and American defense contractors is symbiotic. Israel buys American weapons with U.S. military aid, approximately $3.8 billion annually, now increased, and American companies partner with Israeli firms on joint development projects. The money flows in circles, but it always ends up in the same pockets. There's also a technology transfer component. Israel uses Gaza and now Lebanon as testing grounds for new weapon systems. The data collected, how weapons perform in urban combat, how civilians react to drone surveillance, how missile defenses hold up under sustained bombardment, and gets shared with American contractors. It's live fire, R&D, and the results feed directly into the next generation of weapons that get sold globally. The Israeli government describes this as necessary for national security. The defense contractors call it a growth opportunity, and the people living through it call it something else entirely. Here's the uncomfortable truth that gets buried under national security rhetoric and geopolitical analysis. The defense industry has a direct financial incentive for conflicts to continue. Not to escalate to full nuclear war, that would be bad for business. But sustained, manageable conflicts that require constant resupply, that degrade equipment, that justify budget increases, those are ideal. A war that drags on for years, that shifts from active combat to occupation to counterinsurgency, that requires endless surveillance and precision strikes, that's the business model. And it's working. Defense stocks have been one of the best performing sectors of the market in 2025. Not technology, not healthcare, defense, the sector that makes money when people die. The industry's defenders will argue that these companies provide essential capabilities for national security, that without them, the US and its allies would be vulnerable, that the world is a dangerous place and someone has to make the weapons. All of that is true, but it's also true that the same companies benefiting from those weapons have spent decades lobbying to make the world more dangerous, that they've pushed arms sales to authoritarian regimes, that they've funded think tanks that advocate for military interventions, that they've hired former generals and Pentagon officials to sit on their boards and influence procurement decisions. The revolving door between the Pentagon and defense contractors is well documented. Defense secretaries retire and join Lockheed's board. Raytheon executives get appointed to senior positions at the Department of Defense. The line between government and industry has blurred to the point where it's nearly invisible. The U.S.-Israel-Iran conflict has many dimensions: geopolitical, religious, strategic. But underneath all of it is a simple economic reality. War is profitable, extraordinarily profitable, for a very specific group of companies and the investors who own them. Lockheed Martin, RTX, Northrop Grumman, L3 Harris, GE Aerospace. These companies don't start wars, but they benefit massively when wars start. And they spend billions lobbying to ensure that defense budgets keep growing, that arms sales keep flowing, and that conflicts continue just long enough to justify the next procurement cycle. The stock market doesn't lie. When strikes are launched, defense stocks surge. When casualties mount, order backlogs swell. When tensions escalate, earnings reports beat expectations. A $10,000 investment in Raytheon before the October 7th attacks is now worth over $18,000. Not because the company invented something revolutionary, because people are dying, and dying people need to be unalived with missiles that cost $3 million each and need to be replaced. The question isn't whether defense contractors profit from war. They obviously do. The returns are public record. The question is whether a system where the people deciding on war have financial stakes in war continuing is one we should tolerate. Right now, the answer appears to be yes, because the machine keeps running, the contracts keep flowing, and the stocks keep climbing.